Former Boston Fed President Eric Rosengren joins us right now. He is now a visiting scholar at MIT's Golub Center. And Eric, thank you very much for being here. I know you think that the Fed is very likely going to raise by 25 basis points and then say they'll kind of wait and see what happens. But that's not what you would vote for if you were voting today. What would you do?
Well, my own view is that I do have concerns about the banking turmoil that we've just witnessed. And while I don't think there's likely to be any immediate failures, I do think the banking sector is under stress. So there are a number of reasons for that. Deposit outflows are continuing, and that's in part because of interest rate spreads, not just because of the banking turmoil. I think there are looming problems in the office space. And so the commercial real estate portfolio of some banks that are overweighted in the office space is likely to experience more losses than have been reflected so far. And clearly, there's going to be enhanced regulatory and supervisory focus on large regionals. So I expect the loan officer survey to indicate further tightening of credit conditions. They already were tightening prior to the March turmoil. And on top of that, we have the debt ceiling and the uncertainty that's going to happen as we get into June. So my own view is that the economy is quite likely to slow down in the second half of the year, and that it's not necessary at this point to be raising rates until we get a better view of what the second half of the year looks like.
All of those are factors that your former Fed colleagues are probably very well aware of. Why would they then choose to go ahead and raise anyway? What's the argument for doing it?
I mean, I think the challenge is that if you look at the PCE inflation number, core PCE inflation's 4.6%. If they want to get down ideally to the low threes by the end of the year, the path is on a slower trajectory. So I think for the people that have a more hawkish stance, they're going to argue that the labor market is still tight. Inflation is still higher than they'd like to see, even though there has been significant progress, and that they think that they want to see more evidence that inflation's continuing to come down before and they're not as certain as I might be that the banking turmoil and the challenges facing the banking industry are going to be as much as a headwind as I would attribute to it.
And that 25 basis points, that'll definitely do it, Eric. That'll be the fine tune exactly the amount of demand slowdown that we. Is it me, or is this really a blunt tool? You don't know how much actually is effective in doing what you're trying to do. You got your eye on inflation on one side. You're trying to get to it through some type of nebulous slowdown in overall demand that you're hoping works. And then people say, no, not really. We need to show that we're going to stay the course. So we really don't care if the 25 basis points does anything. We just need to show that we're staying the course. And the North Star, it all sounds like sort of voodoo to me, Eric. And the downside is what you're describing and what others have described. I mean, if the Hippocratic Oath really is do no harm, is it worth it?
So they are very focused on models, and models do have a pretty good way of sensing how higher short-term interest rates will affect the economy. What's much less certain is how much credit availability will affect the economy. Credit crunch periods occur for various reasons, and they don't happen that often. And as a result, the ability to predict how much the economy is going to slow down and how much of a headwind there's going to be is quite difficult. So I think for somebody who wants to see evidence that inflation is clearly getting down to 2% and is uncertain about the credit channel, they would be more willing to raise rates at least 25 basis points. For somebody who puts more emphasis on the banking sector and the credit channel, which I do, I would be more willing to wait. But there's always judgment involved in monetary policy. It's not a precise science.